Good afternoon, everyone. Brett Crowther back with you for another version of Short Verticals. And today I got something very important to talk about. Very important. We could be sabotaging our trades and not even have a clue, which doesn't make sense. I think we like ourselves, right? We want to be nice to ourselves, but sometimes we do things that are not in our best interest, but we kind of subconsciously do it. We don't really know that we're doing it. And I see this a lot with some verticals. And I want to go through that today and help us so we don't fall into that trap of thinking we're in a good position when really we are not. And so some interesting items there. Hey, I just want to give a shout out to Cameron May, who's on with me, taking care of the chat. Good friend of mine for many, many years. It's good to have him with us to handle that. Hey, good afternoon, everyone. Eric, Scott, Jonathan, Richard, Mickey, Zach, Mickey, by the way, thank you for the comment. So he made a comment about on a short video that we did. In fact, one of the comments he made in this class led me to create a YouTube short that we have on our Trader Talk channel. So I appreciate his inspiration for that video. And please make comments, just let me know what you're thinking, and it helps me to better educate. All right. So yeah, got a lot of things to get into. Mainly, let's not sabotage ourselves, but give me 10, 15 seconds to cover some disclosures first. And so let's go through this. Do remember that options do carry a high level of risk and are not suitable for all investors. The information here is for general information purposes only. It should not be considered an individual recommendation or investment advice. Paper money application is for educational purposes only. Short options, we did talk about setting stop losses, or wait, sorry, that's next one. This one, short options, can be assigned anytime in, at, or out of the money. Past performance not guarantee future results. And then on the next slide, this is where we have these stop orders are not a guarantee. It turns into a market order. You can be filled quite differently, possibly from where you actually set your stop order. So please keep that in mind. All right. Let me bring up Thinkorswim right here. Thinkorswim desktop, and I just want to kind of set the stage here as to what's going on, and then we're going to get into, hey, how are we sabotaging ourselves, right? But the overall market off a little bit. We've talked about, what would you say is the overall direction of the market? I'm going to zoom in on this. So there we go. What would you say? Are we bullish, bearish, or neutral, or some version of everything in between? Yes, Will, Ricebird, Greg, Mighty Mouse, Chris, John, Speak Truth, yes, welcome. So I just want to get your take on what the overall market direction is. I think it's interesting, especially as we look at this in the lights of a short verticals class, or a spread, class. Choppy, sideways, okay, neutral. I see a couple neutrals in there. Yeah, okay. And I think I could agree with a lot of that. I mean, if we're really looking at highs and lows in here, I got the SPX up, and so we're checking that out. So maybe it's just a hair larger. There we go. Then if we're looking at highs and lows, I mean, it was going higher highs, higher lows, right? It was doing that. But then we kind of got into this zone here where we're kind of getting equal highs and equal lows, and it's been doing that for a bit here. And so, some days it's up a little bit and some days it's down a little bit. But what is the sense? Mostly the beginning of the year, since, here early January, it's been pretty much just chopping around in that zone, right? Just kind of stuck in there. Chris, my account has been going nowhere fast lately. Yeah, I think, you're up one day, down the next, and kind of recoup it the next day and then give it back next. I mean, we've seen a lot of choppiness. And so this is interesting because this kind of leaves us as when we're looking at positions, what do we do? Are we looking for something bullish? Are we looking for something bearish? Now, I will say, as I go through a lot of the stocks out there, most of them tend to be more bullish. But there are some potential bearish opportunities. And so I want to go through sabotaging ourselves, and I want to look at our existing trades, and then I want to go out and look for other potential trades, paper trades that we can put on there, and then have something to follow up on and discuss in future webcasts and go through, as many stocks as we can in the remaining time. And so that's what we have lined up for today. And so let's get into it. And so first off, I want to bring up one. In fact, we can kind of tie this into actually looking at a potential paper trade here. I want to bring up Netflix here. I think Netflix is interesting in the sense that, if I were to say, hey, what's the trend of Netflix? What would you say? I don't think this one's going to be real challenging. Sure hope not. Got some iron condors, might be good, but I have mixed success on those. Okay, yeah, interesting, Chris. Yeah. So I think you can all see that for the most part, it's been down, right? But it has some action more recently that is altering that kind of overall downward pressure. And the first sign of that was when it broke through this it broke through this one, right? The downtrend. So this is a hit resistance, hit resistance, hit resistance, hit resistance. I mean, this trend line right here was a spot of resistance for quite a while as it went down. I mean, we're talking something like maybe even could have extended that into October. You know, so for October into February, we're talking what, 4 or 5 months there that this has acted as a resistance area, only to find out now that it broke through that just the other day. Let me get rid of that so I can point this a little more. It broke through that 2 days ago, right? But not only that, not that it only break the downward diagonal trend line, you know, the resistance line, but it broke above. We have a 30-day moving average broke above, which, you know, let's be real, it doesn't really follow that moving average. And so it's not really good to say that it's a spot of resistance, but the fact that it's above it, you know, can be beneficial for bulls. And then the last thing though is this horizontal trend line. And to give you an idea of what that is, let's get a little bit more time on this. So let's go out to maybe a 3-year weekly, and you can see on a weekly chart, this ran up, broke through that canyon, bounced off this. What is that, 82? In fact, let me make this smaller. I'm using that for something else, but let me make that just a little bit smaller so it's not in our way. We don't want that, do we? Okay. So it bounced off this 83, you know, price point, rallied up again, bounced off it again. And so when we're looking at something that has, you know, multiple touches, and we're looking at it on a longer term chart, I mean, it has more significance, right? Meaning, a point that's a support that's been held on a daily chart that has, you know, multiple days that are involved in it is more significant than the one that's on a 5-minute chart where it just has several 5 minutes involved in it, right? Because the more data, the more participants, the more significant it tends to be. And so when I'm looking here at this 3-year weekly, I mean, we're talking weeks that were involved in creating these support levels, you know, that carries a fair amount of significance, right? And so that's why I have this long-term support level drawn in on Netflix here. And the fact that it's starting to break above that, well, it's interesting. Now, it hasn't fully broken above. Like if we're looking at a weekly chart, the week's not over, right? This week it's breaking or attempting to break above it. But, you know, has it, in fact, you know, closed above that for the week? No, not yet. All right. I just want to see what some of those comments are. So do you give more weight in the last 6 months or last 6 weeks? Well, that's a great question about, you know, last 6 months or last 6 weeks. And it's not like one is, they kind of conflict with each other, meaning, you know, one of the tenets we could live kind of like follow is the more recent it is, the more significant it is, you know, meaning something that happened a week ago, a month ago is obviously something is more important than something that happened 50 years ago, right? And so the more recent, the more significant, but also the more participant, the more data, the more significant. And we have two things here, right? But in this case, I'd look at this as it's a significant support level. It's been around for a while, and we're looking to attempt to break it. And so I think that's significant. And the fact that it is on a shorter time frame, breaking that is looking to make a move back above that. I think that is, you know, a telltale sign that, you know, the downtrend on this is weakening, and, you know, this could be potentially rolling over. Well, I guess I got a little too close on that. Let me back out just here. There we go. That is starting to gain some life back in it. And so, you know, some people wait for this to roll back over, and it's very, you know, understandable for waiting this to maybe come back and make a higher low, using this as a primary low, saying, okay, you know, this is last low. It already made a higher high, right? Even if it rolls over, we don't know where it's going to roll over, but wherever it does, it is going to be higher than the last high. And so even if it just rolls right here, we're higher. So it's got a higher high. And so the next question is, you know, will this roll over at some point to make a higher low? Well, so now this is where it becomes, you know, then of course, if it runs higher than that, then you start getting that change of trend in the uptrend. And this is where some people get more aggressive than others. Okay. So some people will get in at 0.1, which I would say would be the initial, you know, sign of weakness. And then we get additional confirmation. We make so we have the higher high, higher low, and then confirmation of that is when it breaks this level. And once again, on 0.3, it makes a higher high, which would come in, you know, right. In fact, let's draw a little arrow here, right there, when it breaks above that, you know, because this is going to be the old resistance, assuming it's going to roll over right here, right? Come down, bounce, support. And so you can see 0.1, you know, makes a higher high. 0.2 makes a higher low. 0.3 makes the next higher high. And so there's different levels that people look for as, you know, how much confirmation do you want? And there's pros and cons to each of them. Well, but with this break of resistance, I mean, this could be an opportunity to take something a little bit more aggressive if we wanted to, and maybe we'll do that in this class today. But I want to use this because it also has good numbers to show you something else on. In just a second, let me just check through. We got a lot of comments in here. Lots of talk regarding liquidity gaps. Looks like we have a large one, 78 to 82. Any thoughts on the validity of stock going back to test fair value gap? I don't see a lot of liquidity gaps in this one. There's a lot of heavy trading on this one on Netflix, and so there are some small gaps, but I think they're more just kind of happenstance instead of actual, you know, liquidity issues. Let me check another one. I'm actually not burning through my account. Okay. All right, and then all right. Okay, cool. Now so here's the deal. I want to go out and talk about a trade. Let's discuss. Maybe we go out and place a trade on this. Maybe, you know, we have this. Where is the support level in here? It's somewhere around what, 80. Oh, I got to get off of my drawing tools. My drawing tools was just one I downloaded, by the way, from the internet that we were able to use. So in fact, we can go in and edit on these. One thing you can do on these lines is you can actually get it to show the value. You know, it's 82. It's basically 83, right? Where we could do show price on the right here like this and go, okay, and then it'll show us the price right there. So 83 is essentially where that support level is, right? And supposing it's going to hold and bounce higher from here. Now, with that said, maybe we go in there and play something like an 80, you know, somewhere down in here. We could even get, I don't know, maybe 81, 82, something like that. If we're looking, we could see what the deltas are and just kind of form some sort of a trade, a bull put spread in here, where we're just trying to stay above this long-term old resistance down, new support level to give us a buffer as we look for that to head higher, okay? And so let's go over to Trade tab, see what we have that's being offered. And it looks like if we get out there, we have, well, the standard week, you know, not weeklies, but standard expiration, we only have 22 days in March. And so that one's a little bit tight. You know, a lot of times the juice can be squeezed out of that one. It would be nice to find something in that 30 to 40 range. And we do have this April 2nd, which we could do something there potentially. Sometimes those don't have as much liquidity though. You know, these aren't too bad. Let's look at this. I'm just going to go with the 50 as an example here because they're just they're a little tighter, a little bit tighter. Okay. And so what I want to do is let me change these to, I'm going to do delta, where's our delta gamma theta vega? Delta gamma, there we go, delta gamma theta vega. Now, as you know, a lot of times we talk about delta as this approximation, you know, like it can be used as what is the approximate probability that this strike price over here will end up either in or out of the money, you know, so it's not dead on, it's just approximation. And I'll show you a little bit more of that here in just a minute. But if we're looking at the 85, you know, we could say, okay, well, there's, you know, a 45% probability that that's going to be in the money. You know, and so if as we go deeper down, you know, further away from where the current price is, the probability of it being in the money at expiration obviously drops, right? And so if we're looking for something with maybe a 30 to 40, maybe we get in something like this 82, 82.80, something like that, right? Let's try this. Let's see if this works. Let's put together an 82. So this has a 36. So 82.80, and that gives us 69 cents. Yeah, that works. Let's go 70, see if we can get 70 out of this. Okay, now here's the deal. So we're looking at a trade here where we're looking to get a 70-cent credit on a $2 wide spread. That's our risk. You know, if we have the potential, you know, or we have the right to sell the stock to someone else at 82, or someone, I guess I should say, we have the obligation. So we're going to take it at 82. We're going to sell it at 80. I can put the stock at 82, I should say, and then we can put it to someone else at 80. If I correct my terminology. So we'd lose $2 on that if we have to buy it at 82 and then sell it to someone else at 80. We'd lose $2, but we keep 70 cents, and so the difference of that would be $1.40, right? That's our risk on the trade. And $1.40 with 70 cents, you can see that's kind of a 50-50. I mean, 70 divided by, you know, $1.40 is going to be 50, right? So it's 50% return on risk. And so let's go with this. And And if we're looking at a risk of $1.40, and we've been doing $1,000 of risk. Ooh, look, I got a little too anxious there, didn't I? Let's clear that and try that one more time. We're doing $1,000 of risk in this class, and we divide that by $1.40 of risk per contract on that. Then that's going to give us the ability to do about 7 contracts. Okay, and so we'll crank this down to 7. And then, so everything's looking good so far. Now the question is, shall we place a stop loss on it? Because that's what was asked last week is, hey, let's play stop losses. And so I spent the class last week, and if people want to check that out, go back to, what would that have been, the 19th, February 19th class that we did on short verticals, and it'll talk all about setting stops. And I showed multiple different ways to do it. But we could potentially set one in here, right? And oh, by the way, looks like there's a survey today. Please take a moment, fill that out. I read through every single one of them, and I appreciate the feedback that's in there, the thoughts you have. So please do take a moment to fill out that survey. Okay, but coming back to this is very, very important here, what I'm going to talk about. So stick with me real quick, all right? Let's say we want to go in and place a stop loss, and so there's different ways to place stop losses and stuff. We could say maybe we place one based upon the stock price. Maybe we look at so much of the option that if this goes against us by 30, 40 cents or something, like half its value, kind of lose half its value, then we go ahead and get out of it. There's all kinds of ways to do that. To make this easy, I think for a teaching point, I think an easy way to do this is I'm going to do first trigger sequential, and then I'm going to create opposite trade. And so this is going to be in order to buy this back. And what I'm going to do is, let's go to the chart and let's just look at this and say, okay, well, where can we place a stop loss in here, right? So we have this, what was it, 82.80? And so maybe down in here, maybe 77, 76, something like that. Just, we're giving ourselves some room below, this support level, right? That we're going to place that stop loss. And so, question, how you come up with $1.40? Oh, $1.30. Thank you. Correction. I apologize, Mega. $1.30. Yes, not $1.40. My bad. So that's again $2.10. It's $2. $2 difference. Yeah, $1.30. So here's the deal. If we set a stop loss maybe down in here, 77, 76, like what if we went 77, just down here underneath like even this big bullish candle, right? So let's zoom in on this. So maybe we place something somewhere in, oh, come on, give us a line. There's one drive, there we go. 77, I mean, 77 would be all the way down here, 76 could even go below these. So maybe 77, 77, 76. So I could place this actually on the stock price. Like if the stock gets all the way down here, go ahead and get us out, right? And so let's go ahead and do that. So let's go back to the trade tab. And by the way, just for correction, yes, $2 minus the 70 cents. I did the math in my head. Maybe I shouldn't do that, right? Is $1.30. So $2 minus the 70 cents. And that's our risk. So we're a little bit, actually, we're even a little bit better than I mentioned. I said 50%, but 70 cent reward divided by the $1.30 risk is actually going to give us a 53, almost 54% return on risk. So it's even a little bit better than I mentioned, but I was looking for ballparks in there, but thanks for bringing that up. Okay, so what we're going to do here is I'm going to change this to market and say, okay, just go ahead and get us out. I'm going to come over to, make sure it's good till canceled, by the way, too. And then I'm going to hit the little gear on the right-hand side. No, it's small, but it's right over here. I mean, some say it's cog, whatever, just click on that little star-looking thing. And I can say, okay, I'm going to buy this back. And I already placed it at a market and good till canceled. But then I can say, I can submit this, and I can put when the stock, I just leave it as a mark, is less than or equal to, and we could say like $77. Okay. All right. Why is that? Oh, it's because I have it on large, and so I'm trying to show things a little bit bigger. But it's 77 is what I typed in there. Okay. So it says submit the following order: buy back that vertical, that 82.80, vertical when the current, stock price drops down to 77. So basically it sets us a stop loss based upon the stock price. Now, what will the option be? That could be, there's a lot of things. We could look at the delta and kind of get a ballpark for it, but I just what I want to talk about is just kind of the stock movement and what it's going to do with that. So we're going to save this and we're going to go ahead and confirm and send. Again, sell the 7 contracts, to open, and then buy those back when, as a condition, market triggered by when the market is triggered by number 1. Send that. It should say when it gets down to that price. Let's see if we get filled. Sold filled. Hold on, did I do that wrong? No, I got it. It's right there. I got that right. There it is. Okay, good. Saw both those. I thought, wait, did it trigger them both? So we got our position here. We got our Netflix, and we have our stop loss on there as well. You can see over here. And so here's the deal. So we set up this trade. We're walking around. We're thinking, oh, it's all hunky dory because now we're looking at that delta. We're saying, okay, I hopped in the spread trade, looking for a trade where I have a higher probability, right? So we're at 36 delta. That's in the money. So the opposite of that, or that off of 100, is going to give us the probability, the rough probability of being out of the money. So minus 36 is going to be 64. So we could say it's roughly a 64% probability it's going to be out of the money. And that's kind of what we're going on with the high probability trade. Another way to look at this, and I want to show you this, is we can come up to gamma here and we can change these columns. And one way to do it is do probability of out of the money. All right. And so this is going to be close. Now we came up with the 64. You can see that's going to say 57. It's not exactly there. And so this is where I'm saying the delta is kind of this approximation for the probability. It's not spot on, but this gives us a little bit cleaner look at exactly what the probabilities are. But still, we have this 57, 58% probability. It's still a higher probability trade that this will work out. And had we done the 80, we would have had, even a little higher probability on that. But the point is that we're looking at a high probability trade and we think we're good. Well, here's the deal. This is not a high probability trade. We think it is, but it's not. This is actually, we have less than a 50% probability on this trade. And let me explain that this way. Okay. All right. Let me move this out of the way. Let me go ahead and grab our trade. And I'm just going to analyze that trade. So I'm going to come over here. I'm going to right click on it. I'm just going to analyze a trade. Maybe I should analyze it in there. What if I can analyze it from here? Analyze trade. Okay. So here's our trade. So basically, I've talked about this before, but I think it's really important to understand what this is telling us. All right. So what we have here is, this is the profit loss graph. And so basically this blue line is expiration. And so at expiration, 80 is where we hit max loss. And then right up here on 82 is where we hit max gain. So anything above that, you can see we don't gain anymore. That line of gain. So this is the, how much money we're making. It doesn't go any higher. It stays flat because that's the max gain at 82. And the max loss is at 80. And then somewhere in between 80 and 82, it's a gain or a loss, right? And that's why you have that slanted line. All right, so let me go ahead and kind of like pull this apart a little bit so you get a little more of that slant. And then there's some other important items on this. So up here, it has a probability range. Now this is the probability, this is like a 1 standard deviation of how far the stock should move between now and whatever date this is, which is expiration. So that's 4/18, which is just a day after we have here, which is 4/17, right? And so this is basically expiration. How far should this move with 1 standard deviation? And that's what creates this gray area from here to here, showing us the range, right? And so we were talking about having like this, roughly 60% probability of the stock or this trade working out. And the reason why, in fact, let me do something here. Let me get rid of some of these lines. But which, by the way, this will tell you the probability of being in between the lines. And so, like, for instance, the probability, let's move this one. This is break even at expiration. This is break even today. But if we move these like this, you can see where I'm moving them. It's a 25% probability it'll be in this range, right? As it sits from right now. And a 43% probability to be between what, 81 and 100, somewhere in there. 16% probability to be above 100, and about a 15% probability to be below 71.26. And so we can mess with those. But what I'm going to do is actually going to take those off and just put this at break even. If I come in here and put set slices at break even, then it just says, okay, there it is, break even. Now what we see here is this gives us kind of this box in here. And let's draw this in. There's the box right there that I want to talk about, right? So in this box, we have these two areas. We have one that's down here. In fact, let me draw a line first before I do that. Let me draw this line. Here is that break even right here, right? So there's our break even. And so the idea is that down here, we lose money. And so if the stock is down here at expiration, we lose money. If it's up here, we make money. Whoops, I went a little too far right there. I guess I was one of those kids that couldn't stay inside the lines. And so what this tells us is this is essentially 60% of the time. You can see this is about 60% of the box, right? And this is 40%. So you can see where they're kind of getting that 60-40, that's basically as the stock potentially moves back and forth, that's where it should be. Now, I've explained this before this way, where what they're saying is that the stock has a probability of moving up and down, right? And as it moves up and down, let me grab a different color to illustrate this concept. Let's just grab a kind of purple. So as the stock moves back and forth, up and down, and we're in here somewhere. What are we trading at? 83, 84, something like that, right? So somewhere in here, it's going like this. As it goes back and forth, essentially, now assuming it just went back and forth like that, 60% of the time, it would be in this area, right? In this area here. 40% of the time, it'd be in this area. And so, where expiration is, and then, well, when that comes, there's a 40% chance it'd be down here or 60% chance up there. Here's what I want to stress. The stock moves back and forth. It does not mean that because we have a 60% probability that this trade will work out, does not mean that it will not go below that break-even area or 81, okay? And so understand the stock will move up, it'll move down, it'll move up, move down. Sometimes it may be in a loss, sometimes it might be at a gain. But we need to give it room to move, but noting that as it does its normal fluctuations back and forth, roughly speaking, it should be in our profitable area more so than the unprofitable area, right? Okay. Another way to look at that, and here's where I'm bringing it all the way around, full circle here. Another way to look at that is as it moves back and forth, we're good with our trade. We're feeling good with our 60% probability of success, right? But what is the probability of it dropping down and then, going back up? What's the probability of it coming down? We set a stop loss, at 77? Check this out. I'm going to come up with theta and then go down and say, give me the probability of touching. So there's a difference between going somewhere and staying there versus going somewhere and visiting, right? And the probability of touching, what's the probability of touching? What do we do? 70? Oh, there's not a 77. How about a 76? So somewhere in between here, 77, 76. So we could probably kind of split the difference, say about 50, 56, right? A 56% probability of touching. Well, that means if we have a stop loss at 77 and there's roughly a 57%, 56% probability of touching 77 between now and expiration, that really means our probability of success is what? I mean, there's a 57% chance that our stop loss could get hit, which means our actual probability of success on this trade is 43%. That is quite different from the 60% that we thought we had on this trade. Is this coming full circle? This is an important concept. And so for months as I've been teaching this class, I've had a lot of questions like, hey, why don't you set a stop loss? And I said, well, I kind of like to watch it and stuff. This is why, because I want to give it room to breathe, to make its moves up and down and not get stopped out understanding that by setting a stop loss, we could be shooting ourselves in the foot, altering the probabilities, getting into a trade with low return, like low gain, and actually low probability. But we had no thought or intention of doing that. Question comes up, says, I think we're doing 82, 80, not 78, 76. Yes, you are correct. What I was saying, our trade, so let me back out, make sure we're all on the same page here. On our trade, we did the 82, 80, right? And based upon the 82 strike, there was a 60% probability that the 82 would be out of the money, right? Everyone with me on that? And so that we're saying we have a high probability trade. But then we went and placed a stop loss. I'm going to make that a little bit smaller. We placed a stop loss on it. And our stop loss was at 77. So we have a stop down here, somewhere at 77. And at 77, unfortunately, it's going every 2 strikes, so it doesn't have it. So I'm trying to say, okay, well, what's the probability of touching the 77? And it's somewhere between, we have a 51% it'll touch 76 and a 60% probability to touch 78. So I don't really have it. So it's kind of in between there. That's why I said there's a 50. So I'm kind of like splitting the difference here and saying, okay, well, if there was a 77, it'd probably say about 56. Does that make sense to everyone? If there were a 77. Okay. And so there's a 50% probability. But remember, if it touches, our stop loss could get triggered and we could get filled and kicked out of that trade. And so this is what I'm saying is if there's a 56% probability of it being touched, that's what we're talking about. It's just being touched and triggered, right? Then that means that our probability for our trade is only 43%. And so this is where I'm saying there can be this huge disconnect between what people think they're doing and what they're actually doing. They go into the trade thinking they're at 60%, but actually it's 43. Again, now we have a low probability and actually a low profitability trade. And I don't want to see us fall to that misconception. So please listen as we talk about these, because setting a stop loss alters your probability. You have to think about, okay, what is the probability that stop could get hit? And is that going to alter, what we're thinking of as far as like, what's the likelihood of success based upon the either probability or the delta, whichever you're using as your gauge. Okay. Questions on that? Let me know. All right. So very, very important point. How reliable is touch approximation? I don't have an exact, reliability. I don't know. I've never seen anything to say, okay, this is what it is. I know, gosh, it's been years since I looked at actually even what created that. The comment, I've not had good luck using stops on spread trades. I tend to get nicked out almost every time for a loss. And so that's kind of what I'm thinking, Chris, for that comment. That's what I'm trying to address here is that you set those stops. And like the reason I bring this up, let me show you something, because I thought this was really interesting. Last week we had a trade on Walmart. Now, of course, before today it was looking a little different, but so we had this trade on Walmart. We're talking about it potentially bouncing off the Fibonacci, like one of these Fibonacci's, and we're looking forward to rally from this area. Well, it actually dipped down and kind of bounced off. It gave us almost a morning star Fibonacci pattern, or not Fibonacci, candlestick pattern, right? And so we have the big red candle coming down to a support level. So these 3 candles right here, big red candle coming down, a doji, almost like a hammer, right, hammering out the bottom, and then a big white green candle coming back. It'd be nice to see it go a little bit higher, like at least get halfway through this red candle. That'd kind of form a little more perfect morning star. But we basically have this morning star formation suggesting, okay, it could head back up. And now it's kind of channeling around sideways. But here's the deal, is that we set a stop loss on this. We're out of the trade. It triggered it, right? So this could go on, and we got to follow this through and see what happens and see, does this end up being a profitable, trade had we stayed in it, versus we got stopped out, the day after just on this dip down. And I don't know how many of you have been there where when you set a stop loss, it drops down. hits your stop and rallies back up, and things are fine. But just because it had that momentary, touch, that we're out. All right. Hey, yeah. Thanks for giving the thumbs up, Wiley. Let's see. Isn't it better to possibly have an OCO with gain and loss built in? Let's say buyback at 15 cents, not at 35. Okay, so the question comes up. This is a good question for Mickey. Is saying, okay, what if we just did an OCO, and instead of placing it necessarily on the stock price, so we just do on the option, right? Like maybe if we lose 50% of the value or something like that, we could. But if we come back in here, and what I could do is, let's see, we still have, no, let's go back to Netflix, NFLX. So we could do something like that, but understand it will move as well. One thing I can look at is if you come in where it says single, you see how it has a single up here? I can change this to deep and wide. And I'm just going to go 1 month, one strike vertical. And actually what this will do is it'll kind of create the different spreads, right? And I could have created, it's just easier not to go in here and do this because sometimes it doesn't give you the exact combination you want, but we could come in here and do this. And at 80.82 has about a 5-cent delta, right? So here's the deal. Like if we set that, where's the stock now? The stock's at 85. So going down to 77 is what we were saying. 85 to 77. We'll walk through this. 85 down to 77 is going to be $8, right? $8 on that. And if the delta is about 5 cents, now that will climb as it gets closer to the money. It'll climb. So you can see as it gets closer, it gets like 6 cents and stuff. So, but we'll just use about 5 cents as kind of an approximation. That'd be about a 40-cent loss, right? So we can kind of guesstimate that if the stock were to drop down to that 77, our option would have lost about 40 cents. Or in other words, we sold that for 70, it would have been worth $1.10 at that time, roughly speaking, right? We're just guesstimating here. And we could set that, but the point is that no matter where we set it, there's going to be some sort of a probability attached to that, right? And so in this case, the equivalent would have been roughly around, a stop loss of about 40 cents on the trade, which is a little over 50% of our value. You see what I'm saying? There's still, no matter how you do it, it changes the probability. I just thought the other way to teach it was a little bit easier, but hopefully this kicks in and helps as well. I want to find one more. Let's see. With that said, the logic for higher probability of touching versus lower is fairly straightforward. The more volatility of the stock, the closer price is to the strike, the more days expiration. Okay, yeah, I'm sorry, that's Cameron's comment. Okay, all right. Let's see if we can get. Let's see if we can place one more trade out there though. And so for another example. Oh wait, we got to look at this real quick. We got to see our other positions. So we have KMB and we have Starbucks. Let's look at each of those real quick. So SBUX, this is a trade we made last week, talking about it bouncing off support, coming in this consolidation. Look what it's doing. It's looking good. We need it above 95 by expiration. Anything to do? No, nothing to do. There's still quite a bit of value in that. So we're not at any, 70, 80% or anything. We still have quite a ways to expiration, but it's just doing what it's doing. And so it's looking good. We're going to leave that one alone. And then the other one that we had in there was KMB, Kimberly-Clark. Let's go look at that one up. KMB. And that one, this one hasn't necessarily run. This is where it broke above a resistance level, right? Kind of like what we're doing on Netflix. We started doing it came down, did a basing pattern, rallied back up, broke above resistance. It didn't hold like we wanted it to. Again, would have been nice to wait to the end of the day. But in here, it's just doing its thing. It's kind of drifting higher. Nothing to really worry about or do. It's just sitting there doing okay. And so both those trades, as for now, close this up. Where are they at? Not there. It's one close. So for now, closes down. $85 in the open and $250 from the open on this one on Starbucks. And so we'll let those ride for now and address them next week. So a couple others, maybe ADP. Look at this. So here's one similar to what we were looking at just on, the Netflix and the KMB, right? where it came down, had some rally back up, hit resistance, rally back up, hit resistance, rally back up, hit resistance, break through, almost like a cup and handle on this last little bit here, with this being the cup, and then there's the handle right there, right? And so it breaks out of that. The potential on the pattern would be for it to run about that distance again, about $4 to the upside, you know, on that breakout. And so it looks like a breakout retest, possibility wrapping, going higher. And so let's go ahead and see what we can do with this one with that resistance right at about $30, okay? And so going over to, again, looks like we have 22 or 50 are our options. We'll do 50. 22 is a little bit tight. Let me change this back to single. And we'll look for about a 30 to 40 delta somewhere in there. We got 29 and 42. Well, not really giving us, let's see. I don't know if we're gonna get anything out of this one. We go 29, we'll go 2 wide strikes. They'll give us a 35-cent credit on 2 wide. A little bit thin, a little bit thin. Maybe this one isn't gonna work out like I'd hoped. We gotta we do the 30 and the 28. You know, we're getting a little bit more 65-cent credit. The probability isn't quite as high on that, but you know, still we got a 42% delta or 42 delta. You know, we could look at this as a 54%, 55% chance of being out of the money. And we're making, you know, 65 cents on, well, $2 minus $2 is our risk again, minus the 65 cents will give us a $1.35 risk, right? So 65 divided by 65 is our reward, $1.35 is our risk, is about a 48% return on risk. And so it's a little bit higher. You know, we're going with a little bit lower probability, but we're also getting higher return on that relative to our risk. Let's go ahead and run with this one. And again, with that $1,000 worth of risk divided by the $1.35 or $1.35. Yeah, no, it is $1.35, wasn't it? Yeah. Is again 7 contracts, and so we'll throw 7 contracts. Now I'm not going to put a stop or anything on this one. You know, we're just going to watch that. So again, here's our order: sell 7 contracts at 65 cents, potential of 455, potential loss of 945. Send that off, and then we're going to go over to the chart, and that one expires the 3rd Friday in April, which is where are we at? 21st March, yeah, 20th of March. So we'll grab our box and we'll say we need to be above 30 by, I'm not gonna get up to March, am I? I'm gonna have to add more time. Add a little bit more time on this, change the time. We'll do 60 days to the right. By that, that'll give me probably more time in there. Okay, activate that. I want to drag this out to, there's a 20th right there. Okay, so we just want price action to be somewhere in this, you know, it can go as high as it wants, but at least above this level by the time it gets here. So we'll leave that one as is. All right. Okay, let's see. I think we got all the questions addressed. Assuming this is 0 days till expiration, doesn't make any difference where the security price is at closing as long as not above the strike. Not sure where you're going with that on the 0 days to expiration. A lot of times people look at that getting in at the very end of the day, you know, but they will look for it to close above a support level or something like that on a bullish trade. Short vertical, do we have the short vertical? We do not have to create the opposite order. I'm new, so asking, no, we don't have to create the opposite order. Well, the opposite order was only for when we were setting the stop losses. And so that's why I did that, create the opposite order, but no. And so hopefully this explains why some traders like to just not have stop losses on there, but just to manually kind of keep an eye on it, right? And say, okay, when is it falling apart technically? Or when are the numbers, you know, when are the value of that option saying, okay, it's time to get out, rather than leaving it for a, you know, a one hiccup thing like we saw on Walmart that didn't change necessarily the outlook. It was still there, but you know, we got stopped out and we're out of the game, right? So important stuff. Thank you for joining me. Thank you for the questions. You know, we'll have to spend another one on this the topic or something near it to address those questions. But please add questions to the comments below. Go back as we post this session. add your questions to those comments, and we'll address them next week as we come back. And then I also just release some YouTube short videos you can check out that will address some of the topics like the morning start we were talking about here, like the formation, what makes them important. So check that out as well. But until then, enjoy your week. I'll catch you next Thursday, same place, same time. So I look forward to having you all there with me. Till then, have a good one.